Hi team, in this video we are going to work through the balance of payments and its individual components. So you need to obviously understand what it is and what it's made up of. So before we get into the nitty-gritty of it, let's zoom out for a moment and get our heads around what the balance of payments actually is. So considering the large volume of international transactions Australia makes to the rest of the world, it's incredibly important that we measure this, and that's what the balance of payments strives to achieve. It's basically an annual measure of all the transactions between Australia and the rest of the world. And if you think about it for a moment, that's a lot of money coming in and out of our shores that we need to keep tabs on. So the balance of payment is broken into two distinct accounts: the current account, which we will spend a lot of time talking about, and then less so, the capital and financial account, sometimes referred to as the CAFA. So on paper, this is what the balance of payments looks like. If it's your first time seeing it, don't stress out. We will make sense of all these different bits. Effectively, like I said before, it's broken into the two sub-accounts. So you can see the current account up here in the green and shooting off 4 more sub-accounts. And then you've got the capital and financial account with a few more sub-accounts shooting off. Now, what you want to take away from this slide is to start to think about this idea that the current account plus the capital and financial account are equal to 0. Now, the reasoning behind this is that basically this is a giant accounting system. Accounting systems are built such that if there is an entry with money coming in, there is a corresponding entry with money or value going out. And in essence, that means that it's always equal to 0. Now, from an economics perspective, that's important for us to know because it dictates the relationship between the current account and the CAFA. So if we see an increase in the size of the current account surplus, and I'll talk about what that means in a moment, we should see a corresponding decrease in the CAFA such that these two accounts always add up to 0. And we'll talk about that in a little bit more detail in a moment. But let's start by getting a handle on what our current account is. So the current account is made up of these 4 sub-accounts. And before we get going, let's understand the flows of money. So if money is coming in, basically that means that it's a credit. So if you hear the word credit in respect to the current account, you think, right, money coming in. And the opposite of that is a debit. So if money is going out, it is a debit. So if you hear the word debit in respect to the current account, it means that money's going out. So we're going to be talking about credits and debits a lot. So it's really, really important that you understand, right, credit equals money in, debit equals money out. So on that note, if we look at the balance of merchandise trade, we understand that as being the difference between the value of goods exported and the value of goods that are imported. Now, let's apply the terms debit and credit for a moment. If you're exporting a product, the money is flowing into your country. So you're dealing with a credit. So whenever you talk about exports, you are talking about credits. So we like to refer to these as export credits. It insinuates that the money is being received by Australia. The flip side of that thinking is, okay, well, if we're dealing with imports, that means that we are sending the money overseas, which means the money is leaving our shores, and that is a debit. So all imports are denoted as debits. So I'm going to start to use the terminology export credit, import debit. And in respect to the balance of merchandise trade, we're simply talking about the difference between export credits and import debits in respect to goods. Okay, so how many goods did Australia export overseas versus how many goods did Australia import, and what is the relative difference in value of those two sets of the equation? It's the same thinking for net services, except we're dealing with services, okay? So the difference between the value of services exported, so export credits, and the value of services that are imported, so import debits. So like I said before, same thinking, but different product. In this turn, we're talking about net services, okay? So together, the balance of merchandise trade and net services make up the import and the export of all your goods and services. And to simplify things, the balance of merchandise trade and net services is sometimes collectively referred to as the balance of goods and services. So if you ever hear that you're dealing with the balance of goods and services, it's talking about these 2 sub-accounts. If you have a balance of goods and surpluses surplus, it means that our export credits were greater than our import debits. Okay, surplus implying that there's more of. If there's a surplus, it means we've got a positive number, a positive dollar figure. It means that we've earned more money from our exports than we've lost sending money offshore for our imports. Okay. Now, secondary to that is the net primary income account and the net secondary income account. Now, these don't have anything to do with imports and exports. They are different flows of money for different reasons. So with the net primary income account, this basically is capturing any income that is sent overseas to overseas owners of Australian assets and vice versa. So the difference between income earned by residents of the country from their investments abroad and the income earned by foreign residents from their investments in the country. So let's put some colour around that. If we're talking about income earned by residents of Australia from their investments abroad, I want you to imagine for a moment that you're sitting in Australia and you own a share in Apple. Over time, Apple is going to pay you a dividend for the ownership of your share, and that dividend is income to you. And so that income is going to flow from Apple in America to you in Australia. That is money coming into Australia, and it is income coming into Australia. So it is a credit, okay? And that credit is recognised obviously as money coming in within the net primary income on the current account within the balance of goods and services, within the balance of payments. Let's flip our thinking for a moment. The back end, income earned by foreign residents from their investment in Australia. Let's take a big Australian company like BHP, for example. They issue shares to their shareholders. It may be the case that someone in Germany owns a share in BHP in Australia. And then when BHP pay that dividend to that owner of that share in Germany, they are sending income from Australia to Germany. So from Australia's perspective, that is a debit. It's money going out, and it also constitutes income. So it is a debit out of the net primary income account. The other thing I'd like to add to this conversation is the fact that we are going to be talking a bit about interest repayments in the next video. So over the years, just for context, and this we'll talk about it more later, but just for context, Australia has needed to borrow a lot of money from overseas borrowers over the decades in order to grow our economy to where it's at. And so we actually have a lot of debt that we need to repay our lenders overseas. And so when we repay them the interest that we owe them on the money that they have lent us. That is recognised as income from their perspective. So we are, in essence, sending income earned by overseas lenders from Australia to those overseas lenders. So money going out, debit, and it's an interest repayment, which represents income for the recipient. So it is a debit of primary income out of the primary income account. We'll talk about that more later, but when it comes up, just come back to this and think, hang on, it sits in the current account, it sits under net primary income. That's going to help me with my understanding a little bit further down the track. And probably the nicest of the four is the net primary income, the net secondary income. I mean that in the sense that it's quite simple. So from Australia's perspective, this is usually the transfer of foreign aid and gifts to other countries. So if we provide foreign aid or a gift to another country for any reason, obviously that's money going out. That's going to be recorded as a debit. I'm sure you can understand that we don't often receive income in this space. We're the ones that are usually giving out foreign aid and gifts to other countries. And so these are the possible outcomes from all the inflows in and out across those four sub-accounts. So we said before credits was money coming in and that debits was money going out. So over a 12-month period, if credits coming in exceeds debits going out, it means I have a surplus. It means I have a positive bank balance. And so what we do is we refer to that as the current account surplus. So if you're dealing with a current account surplus or a CAS, it simply means that for that 12-month period, Australia has enjoyed more money coming in, more inflows relative to money going out for a whole host of different reasons, right? If we go back to all the sub-accounts for a moment, we might have enjoyed a situation where we exported more than we imported. We might have a situation where we received more income than what was paid overseas, okay? So there's a whole bunch of things sitting there that can lead to a CAS. The flip side of that is obviously a current account deficit. Deficit meaning that we've got a negative balance, and that occurs where debits, money going out, exceeds credits, money coming in. So they're the two possible outcomes. You can also have what's called a balanced current account, and that's where credits are equal to debits, but these are extremely rare. These are more the ones we tend to speak to, okay? So looking at the graph, there's a lot going on here, but I want to draw your attention to the dark purple line, current account balance, and let's have a look just at the last few years. So interesting to note, if we look at this sort of crossover between 0 percent. Basically, this is saying, let's call it, I don't know, early 2018, sort of into 2019. We go from a situation where historically Australia has run a current account deficit into a current account surplus for a very long time. First time probably since 1990, and I don't have any other data before this. So we've got to ask ourselves, what's happened? Why is it the case that we've gone from historically having current account deficits to more recently enjoying these current account surpluses? And I say enjoying because if you have a current account surplus, it implies that your flows into your country exceed your flows out of your country. And if you think about that from a living standards perspective for a moment, it implies that your country is enjoying improvements in purchasing power, higher standards of living, all those kinds of things. We'll get into more detail about that in a moment, but a current account surplus provides opportunities for investment and obviously gives your country a little bit of freedom as to how they want to spend those surplus funds. Okay, so now we come to the second part of our current account, and it is the capital and financial account, and you'll see that it's made up of the capital account and the financial account. Now, you don't spend anywhere near as much time analysing this thing as you do the current account. All the action tends to be in the current account, but it is important for understand how the CAFA works, because as I said at the start of the video, the current account plus the CAFA has to equal to 0. So it's important to have a sense of what's going on in the CAFA. So the capital account starts by recording all transactions related to the purchase and sale of non-financial assets. I'm not going to go any deeper than that. That's really all you need to know. And then the financial account records the flow of financial assets between countries and the rest of the world over a specific period. So if we look at a series of assets, if we were to classify some as financial assets, basically we've got direct investment, which is the purchase of assets, portfolio investment, which is the purchase of shares and securities, reserve assets, typically RBA and government transactions of foreign currency, and then any errors and emissions. Now, I don't need you to be an expert on what these are, but you do need to have a handle or an idea that the capital account captures all transactions related to the purchase and sale of non-financial assets, and the financial account captures all flows of financial assets, okay? We'll play with that one in a little bit more detail later, but keeping in mind, team, that this really is the gold standard that I need you to walk away from today's video with, okay? So your current account plus your capital and financial account are always equal to 0. So let's go back to the current account for a moment. If you had a current account surplus, which implies the current account is increasing, what must be happening to the CAFA in order for this equation to be equal to 0? Well, by logic, it would mean that the CAFA must be going down, okay? So an increase in the current account surplus leads to a decrease in the CAFA. And the opposite is true. If you start to produce current account deficits and those deficits start to getting bigger, it means that the current account deficit is getting bigger, which in turn means that the current account is worsening. And so in order for it to be equal to 0, the CAFA has to be increasing. Okay, so apply that logic and you'll never go wrong. All right, so let's talk about some numbers, some actual numbers from what's going on over the past few years. You do need to know what the current account surplus is equal to in Australia and what that means for the CAFA. So you can see on this graph here, there's a little bit going on, but you can see that you've got a current account balance equal to $11.8 billion. And that's a surplus because it's a positive figure. And we know that because when we looked at this graph back here, we could see that we've been dancing on a surplus for a number of years at this point. So we've got a current account surplus equal to $11.8 billion. If we apply that sort of to the last 12 months or so, you can see that there's been a little bit of a spike. And basically over here, I've said, okay, well, if the current account surplus is equal to 11.8 billion in surplus, well, then the capital and financial account must be equal to negative 11.8 billion in deficit for that 12-month period, such that the whole thing is equal to 0. So a surplus in the current account means that the CAFA must be in a deficit by the same amount, and there's your equation. With the current account in surplus, this means that Australia has excess funds that are either used to repay existing loans or loaned out to overseas borrowers. Now, we're not going to go into the nitty-gritty of it, but with those excess funds, Australia is likely going to use them to repay existing debt that they've already got, and that repayment of that existing debt comes out of the CAFA. Okay, we don't need to identify where or be too specific about it, but basically, If we're running a surplus and we've got excess money, that money is going to potentially get used to repay existing debt, which is captured as an outgoing of our CAFA. So like I said before, team, current surplus up, CAFA down. Or the money might be lent out overseas to overseas borrowers. But either way, the excess money from the surplus is going to go offshore in the sense that it's going to complement in an opposite direction that change in the current account surplus.